Welcome to Grey Market Talk with Nic Themistocli, fund manager extraordinaire, chief investment officer who is running trillions, now I'm exaggerating, 80 billion assets under management, and Thorsten Wegener, former market maker and now retired market pundit, Finfluencer. We'll have a little section on that later. And let me welcome Nic now, who is here to answer a lot of questions I have after this week. Hello, Nic, how are you? I'm
very good. Very warm.
That is very good. You are a Brit and you are Greek Cypriot, yes. Greek. How do you, what's first in that explanation?
Cypriot, I think, is the term, but Greek Cypriot is okay.
And obviously, the topic I want to start with to make the most out of your British heritage in this whole thing is something I don't get my head around. And let me share my screen because I think that makes it very obvious what will be the topic. Share screen. Ah, there we go. So the quite interesting slides. UK, what's different now? And what I have here on the screen, if you can see it, is the 2 years and the 10 years in gilts. And the little yellow lines are actually very interesting. They're from September last year, 23rd. That was when Liz Truss and Kwasi Kwarteng introduced their mini budget in the UK. And that mini budget was actually borrowing 70 billion pounds sterling more. And what the press was focusing on by removing the top tax rate and also introducing or eliminating the cap for bankers' bonuses. And the market went absolutely batshit crazy after that, which I found very interesting because in the world I'm living in, I have seen London at the best of times, worked at the best of times. And you remember as well, when did all the Frenchies, when did all the Germans, when did everybody flock to London? When you had big bonuses and low taxes. And they brought their businesses and their employees with them. And London was the city which actually fed the whole nation. So I understand that Kwasi and Ms. Truss wanted to come back to that. The funny thing is, I don't know whether I actually told you, Kwasi Kwarteng was one of my colleagues when I was working at West Elby Penmuir in London.
Ah, there you go.
Yeah, and I don't want to be wrong, but when I was standing outside smoking, I think he was also a smoker. And I noticed him because he's this tall, good-looking guy, and he had suits, which I think were worth more than my car I was driving at the time. I was absolutely one of the smartest cookies they ever employed in our outfit. And when he was then eventually brought into the cabinet as a chancellor, I thought a very, very good choice. So the second line I have on the screen, the little yellow line, is actually Truss immediately on the 2nd of October, a week later, acknowledging that they made a big mistake. Yeah? Market was already crazy, rates out of control. And I hope you can fill me in actually in the background of this all. And then if we go to the 14th of October, the third yellow line, that's when Kwasi Kwarteng resigned as a chancellor after Mrs. Truss dropped him. And said, okay, we have to roll it back. And obviously I made mistakes. And I haven't put in a fourth yellow line because that was a week later when Ms. Truss had to resign after 44 days in office. And was it the Daily Mail which had a live camera view of a cabbage there and asked,
something like that.
Which will last longer?
The lettuce, wasn't it? Was
yeah.
Which one will out-survive the...
Who will survive longer, Miss Truss or the salad? Yes, and obviously we all know what happened.
Yeah.
So yes, that was, you could say, almost now ancient history what we've seen there. And now, if I look at the current rates, we're exactly back again where we have been when all this panic was. First of all, my question to you, Nic, why did this panic ensue after they made this announcement? What was the system risk, the systemic risk, the failure everybody was afraid of that could happen in the UK? And the second question, why is it different now?
Okay, but before we talk about what happened on that first yellow line, I mean, you got to look back what happened before that. And actually the chart you've got, it's good that you've got this chart actually, because it shows you that what Crazy did was actually nothing to do with what actually happened next. So, you know, you can say, what do you mean? Surely he screwed things up and yield shot up by 100 basis points in 4 days. It was all his fault. You know, what are you talking about? Well, have a look at what happened before that. And 1 month before, yields were, you know, close to 2%. Let's just say they were 1.75%, right? In August. Yeah. Before he spoke, yields in 1 month rose to 3.5%. So that's yields already doubled. So timing is everything. And obviously, you know, his announcement was bad timing, frankly. At the end of the day, if you're going to do something like that, you're going to go against the trend. Your central bank has already said, we're going to do quantitative tightening, you know, rates are going up. You know, somebody you know, over there has caused inflation, not us, and we're going to have to do something about it. And then you enter a policy whereby, you know, suddenly you're going to require some buyers of your paper. You know, you've got to prepare yourself for that. And you've got to look at, is the market right for me to do it? And clearly there was already momentum to say that, you know, the market was already heading higher in yields. So you need to think, okay, what is the effect of my action? Perhaps I need to get on a plane somewhere, go to Saudi, go to Asia, and try and find buyers for my paper for such a policy. And I think, you know, he was ill-advised, not necessarily about the content of his policy, but the timing. So you may want to have a growth-driven policy, and obviously, frankly, everyone for a change needs a growth-driven policy, but you don't do it right when the locomotive is going the other way. So you need to, so timing. Timing was bloody awful.
So wasn't there huge institutional resistance against the policies they were proposing? Because obviously I have English television, still living in Germany. It's far more entertaining, especially listening to Parliament, than German television. And the thing they banged on and on and on about was the top tax rate, the cut to that, and the bankers' bonuses. It was almost like a frenzy.
So whether the growth-driven policies that he actually came up with as a bundle was actually going to drive growth, or whether it was just to please certain members of the faction, you know, that's not necessarily the story here. I'm sure if he'd have come up with, you know, we're going to set up a growth fund, we're going to invest in the economy, we're going to invest in science, we're going to invest in technology and in you know, health and all of this stuff, and that will drive growth. You know, nobody's going to resist stuff like that. But when you sort of your top line is actually we're going to cut rates, going to make the people who've got money richer, and you know, we're going to tweak here and there, and everything will be fine. You know, perhaps the bundle wasn't the right bundle, but the idea of growth-driven policies, in my view, is right. What is not right in this environment is austerity. And, you know, Jeremy Hunt, of course, has decided to go for the austerity side in order to basically say, look, we've got everything under control. Don't worry about sterling. It's fine. We're not going to borrow any more money. And everyone will get richer. No, they bloody won't, and that will bite them in the end. So, but, you know, that's a future conversation. Let's talk about what then happened. So yep. He's launched his policy at the worst possible time, and then of course, you know, the locomotive says, you know, is this something I like or is it not something I like? Bang, okay, and yield shot up another 100 basis points. Frankly, as I said, how much of that 100 basis points was going to happen anyway? Well, you know, you've just answered that for me by saying we are where we were then. So it's going to happen anyway. Yields are going higher. There was nothing that he said in reality that changed anything, because in the end, you know, the central bank has decided that it's on a path of you know, raising interest rates, and the UK do need to borrow money. So So he's done this. It's all at the wrong time. But, why did it sort of accelerate at the time? And there were this pension fund thing. Yeah, I mean,
that was the big talk of the town, that the UK pension system would inevitably now blow up.
Okay, pension system is a bit sort of the wrong word. Pension funds were in trouble. So if I just say that, simplify it, let's just look at pension funds being of three types. Sort of one being defined benefit. That's the pension fund that basically promises its members that it's usually driven by company, benefits. Company promises its staff, you work here a certain number of years, you'll get retirement based on your final salary.
Yep.
They cottoned on fairly quickly that actually that was an incredible promise, and it was a promise that they couldn't deliver easily. So the defined benefit plans, basically, there aren't that many left, and they morphed into defined contribution. Defined contribution is basically where you look after your own money. And then there's the third aspect of pensions where, you go to somebody and say, help me out with my pension. I need to retire in a couple of years' time. Please look after my money. So the first lot, the defined benefit schemes, over the years had built up, corporates, for their staff, had built up huge deficits. So in other words, the promises that were made, when you present value them back into the present, and you put some assets against it, suddenly the liabilities, the money you owe your members, your staff in the future, was much greater than what your assets were worth.
Yep.
Right? So, and it didn't help when interest rates went down, because as you know, the liabilities in the future, when interest rates go from, let's just say 5 or 6% as they were, for many years, and even 10% for years, when you discount them at 0 or 1% or 1.5%, suddenly this liability becomes even more massive versus the assets that you bought. So you bought some stocks, you bought some gilts, and your liabilities were hugely. So what you had were UK corporates in the FTSE 100 and the FTSE 250 that were full of these pension deficits, and they were, if you like, a drag on corporate profitability, because the members, they go back to the management, they say, look, there's a huge deficit. We don't know if you're going to be around in 20 years' time. So can you please stump up some money to narrow the gap? Obviously, we don't expect you to pull up all the money today, otherwise you'll probably be bankrupt. So please, bridge the gap every year by a certain amount. So corporates were spending their money instead of paying dividends and share buybacks. They were pumping the money into the pension schemes in order to reduce the deficits, which were widening every year as interest rates, as we know, for the last 20, 30 years have been going down only. That is the story, because what these pension companies were doing, not all of them, and I've advised on these things before, is what they did was they leveraged themselves. So they've got some gilts. They go to somebody and either do what's called a total return swap, or they do some kind of leverage. They say, we've got a certain amount of gilts. How much can I leverage my investments, with this amount of gilts? And some of these people were leveraged 3 or 4 times on those gilts. Now, what that meant was that when the value of those gilts were rising, they were actually receiving money. So, they thought, well, we did the right thing. It makes a lot of sense. But the moment, and as you can see, on your chart there, for the last year, interest rates have been going up. And suddenly, in the space of 4 days, rates had exploded another 100 basis points. And what that meant was, with 4 to 5 times leverage, let's just say, your collateral pool, which is your gilt, is probably just enough to cover the losses on all of the stuff that you've bought, which is now worth much less in price. And what have you got to do? you've got to then sell your collateral to actually sort of raise money to pay for your margin calls from these guys. And then by selling your collateral, by selling the gilt, you make the market even worse. The market goes down again, you've got to sell more collateral, goes down again. And that's this sort of spiral that took place in 4 days. And that was, that's really the big thing about what was affecting these defined benefit schemes at that time. Now, you said, but surely, Nic, we are at the same level. Why haven't we got, bankruptcies all over the place in the UK?
That would be my question. Have they used the time to deleverage now? Is everything hunky-dory? Yes, we can live with higher rates, no problem whatsoever, because we've deleveraged. The next slide, I quickly just scroll it in, is the real interest rates, and the UK's suck as well. Yeah? So you have guys who are paying into their pension contribution. You have negative real interest rates. The funds have deleveraged. Now we are at levels which are higher when this mini crash, let's call it that way, happened. What has changed? Am I right? Have they deleveraged, or is it just not talk of the town at the moment?
These defined benefit schemes are doing exceptionally well in such an environment. They are, now that, so go back to when interest rates were 1.5%, they had to discount their liability by 1.5%. Yeah. Now interest rates are close to 5%, and you discount your liabilities by 5%. Actually, they discounted by a 5-year AA bond, or whatever. But let's just say discounting it at a much higher rate. Now their liabilities have fallen like a stone. So their assets. So if you look at what the difference is between, and there's a pension regulator who publishes this data, and there was an article earlier this year which basically said that sometime, I think it was March, the article, that these 5,000 corporate pension schemes, which they defined benefit schemes, which they monitored, was something like 250 or 300 billion in surplus, having been in deficit for the last 10 years. So the state of the defined benefit schemes, they are extremely healthy. They took an unnecessary gamble at the time when rates were going up, because at the end of the day, what they didn't understand was, maybe they did understand and they were just being greedy, that when rates go up, their liabilities fall, and therefore they don't need leverage in order to match their. So this was just, again, this is, for me, this is Silicon Valley Bank all over again. This is some people who were managing their assets and didn't understand what rising interest rates were actually having an effect on their portfolios. And so, a few got caught out, but at the end of the day, when your liabilities are worth less than your assets, actually, what you can do is you can reduce your risk by going to an insurance company and saying, well, actually, can you take over my liabilities for me? Because now my assets, should be able to cover this. And these guys these corporates will no longer have to pump money into these pension schemes, and they can start pay dividends, start to pay, repurchase shares, and so on and so forth. So the burden on these defined benefit schemes is a lot better today, a lot lower today than it ever was, I would say.
So we are not in trouble, because I've seen also the UK managed to not slip into a recession yet, even though inflation is high. I read that food price inflation is coming down. We had this slide on last week or the week before about food price inflation. So what we are seeing at the moment on the screen is actually caused by the actions they took during the crisis, and now they are in a better position.
Yeah, I mean, but, the crisis, as I said, rates were going up anyway. When you look at that line, that's near the top, right? This yellow line is near the top. And, as I say, Kwasi and Liz were just bad timers.
By the way, do you know that Kwasi Kwarteng defined a new period of time? Now you can claim the shortest time you actually held a job to reasonably claim that you have the job is now called 1 Kwarteng. I read that. Absolutely brilliant. No, thanks for that explanation, Nic. That helped me a lot because as somebody who's not into gilts or on the bond market in general, you just see what happens on the screen and you think, wait a second, I heard that a couple of months before. Now we are at levels actually higher at that, and it doesn't seem to be a crisis anymore. No government is falling about it. But that explanation makes a lot of sense you gave me.
I mean, just another 30 seconds, if I may.
Yeah.
I mean, the people that it does impact, so yields are close to 5% there on the 2-year. So the third category of that I mentioned at the start of the type of pension, where you go to an insurance company or you go to a pension company and you say to them, you know, I'm retiring in 10 years' time, please look after my money. And the closer you get to retirement, the theory goes, and I run such a business, right, with my partner. You know, the theory goes, when closer you get to retirement, you've got to de-risk a portfolio.
Yeah.
Now, we took the view of de-risking portfolio was not, you know, minimal amount of fixed income. And we look for alternative investments because we knew in such an environment that, you know, fixed income will get absolutely buried. And some of these people, poor people, unfortunately, who were, you know, approaching their retirement, gave the money to insurance companies who, like robots, just said, okay, de-risk. I know what that means. I know what that playbook means. Go and buy government bonds. So they went and bought government bonds for their clients. And suddenly these portfolios, 2-3 years ahead of someone's retirement, is 30% underwater or thereabouts. And you know, this is who's getting affected right now. People who have entrusted their money with bad managers.
Maybe follow on question on the other side of the equation. The housing market is a big thing in the UK. Just an example, I think it's 75% of British citizens own the place they're living in, as opposed to 25% in Germany. Germans are mostly renters. UK residents own their place. If we now see inflation still at high levels, and I think last week or the week before, a couple of the big lenders came out and actually pulled their mortgage rates and made dramatic increases. What influence has that on an economy that is so highly geared into ownership? That surely must have a negative impact on growth rates in the UK.
Yes, I mean, what you're rightly saying is that if you've got a mortgage that used to be at 2% and is now at 6% or 7%, you know, can you afford that? The answer to that question is it's going to be very difficult for you. Yeah. So, you know, it affects spending, retail sales, you know, it affects mood on the economy. I mean, this is not good. But one of the things that I fundamentally believe is that governments around the world, it's not just the Western world, cannot accept any longer, with the level of debt that we've got for all of these large economies, a situation where the economy falls, right? I mean, we talked about we need, you know, everyone needs tax revenue, you know, otherwise the debt spiral is just, you know, it goes crazy. And not everybody is like the Americans that just can carry on printing and it doesn't seem to matter. But, you know, my feeling there is I would be really surprised. And the answer to the question at the end of the day is, yeah, that's bad. It's bad everywhere when that happens. But if it gets really bad, I actually expect the regulator, you know, probably pushed by government, to stand behind these people and say, look, if somebody falls behind on their mortgage, you're not going to foreclose. You are not going to sort of grab you're going to give them, you know, the time, you know, to repay. I would be really surprised if you suddenly get to a crisis where people can't afford to pay and then they get kicked out. There's no way that the government or any government can accept that.
That would be my final question to that topic then. Is there a long gilt trade eventually coming up? Are we at levels already, taking this scenario where we think we are at high elevated levels, they can't actually drop it. The government has no choice eventually to reduce rates dramatically. Otherwise, the whole system falls apart. Are we too early for a gilt trade, or is it already worth considering building up first positions?
So we actually briefly touched on this, I think, last week, but I'm not sure. When I talked about fixed income in general, I think if you believe that ultimately the only way that governments can actually get out of their debt problem is by inflating their way out of it,
Yeah.
Now, that can only happen through negative real rates, and that will go on to your next slide. And, you know, if they start to have positive real rates, and the US is very close to both factors, I think it's just flipped. If you get positive real rates, that's not good. Ultimately, I believe there will be negative real rates. And then the theory goes, well, actually, if you've got negative real rates, why would you buy a government bond? Because surely inflation is much higher. Well, the answer to that question is, well, that's simple. You already had your money in your bank account earning 2/3 of nothing for the last 10 years. And there was already inflation of 2% or 3%, or your inflation might have been 5%. So you already accepted a kind of, stealth wage, tax, if you like, on money you had in the bank. So, I think if somebody offers you 4.5%, 5% gilt yields, 2 years, I think people will grab it.
Good, thank you for that. Nic, let's move on to the next topic, and that is ESG, environmental, social, and governance. And before I open the next slide, let me light up some tobacco, because I want to show how I strongly support ESG, and especially the companies with the best ratings. That was an article from the Daily Mail, and you see the ESG scores here. Do you care to comment on those?
Yeah, well, it's very interesting.
BAT is not longer called British American Tobacco, right? It's just BAT now.
Yeah,
they
probably.
deem that politically incorrect. Then we have Philip Morris, Imperial Brands, though 3 tobacco makers, then Shell, a company which is producing carbon products, and then we have one company I would consider environmentally friendly, Mr. Musk, and then again Mr. Musk made with Twitter in there. And the interesting thing for me was, these are the official ESG ratings. And what we've seen is that the tobacco makers are obviously very, very good in these official scorebooks that are out there. And I made my thoughts about environmental, social, and governance. What does that mean? You produce something. Environmental means they, whoever they are, want you to actually not impact your environment. So you take this out of the equation. Social means you should give up on the profit theme. Your best is you don't make any profits anymore. And governance means they want you to have as many compliance officers and bureaucrats in your corporation as reasonably possible. Then you get a high score, ESG score. And why I'm discussing that with you, you are actually, in your function as a chief investment officer, you have forces pushing you into the direction that you have to invest in ESG-friendly products. Obviously, I'm now a bit mean with my interpretation of, they want to take out the profit motive, they want to take out any influence on the environment, and they want to introduce more compliance officers into the whole business framework. You have to square this circle. Your clients want you to invest in products which increase their wealth. At the same time, I put my framework on when I say, how is that actually possible? So how do you wander between these two worlds of still being able to make decent profits out of investing in corporations which produce real stuff and therefore have an impact on the economy and the environment, and companies like, Twitter, where they need a bit of electricity basically to run their computers and have a social network? How do you navigate this framework?
So, I mean, you're using the present tense. Of course, chief investment officer was time in my past. We manage money for clients. So we have it's not of the same caliber as running a 60, 70 billion investment thing. But, at the beginning, ESG was a mood where a number of institutions, investors who wanted to actually show good faith entered and said, okay, we're going to clean up our portfolios. We're not going to have this and that in the portfolio. And we want to show not just to our, our members, but also to the community that we are serious about this thing. And initially, ESG, you could argue, was one of these factors. There was an ESG factor where a number of investors got into this thing, actually drove up the prices of ESG-friendly assets. And I'll use that sort of term loosely, because what is an ESG-friendly asset? Let's just say it's something that has a good ESG rating. And there were some good ones, good rating providers when I was doing this job. But since that time, what then happened was everybody got on the bandwagon, and suddenly every portfolio was ESG friendly. And there was this greenwashing going on, greenwashing meaning they're not really ESG friendly. And it was almost a cowboy kind of behavior in the markets. And that's where ESG kind of lost its sort of value, if you like, because, the market wasn't treating it seriously. The world has kind of moved on now, and the regulators have understood that you can't, on the one hand, require, say to your people that we're going to go to net zero, we don't want you to finance this, that, and the other sort of CO2-related, fossil-related industries, and yet at the same time have these rating providers control everything. So the power of an ESG rating provider suddenly is immense. So the EU have, if I understand correctly, have just introduced legislation to bring these rating providers in line with some kind of regulation to make sure that their methods are transparent and all of this stuff. I mean, it's the start again of trying to get some credibility into the industry. And your ultimate question is, do I take this stuff seriously? Well, when they were acting like cowboys, when the industry was acting like cowboys, you couldn't trust any kind of label. The answer to that is no. But it doesn't mean that ESG per se is something that you should totally ignore, because what is it that is ESG right now? What ESG is right now is two things. It's the stuff that you're not allowed to invest in. Well, for the stuff I'm not allowed to invest in, let's just say we put that in a separate box. But for the stuff I am allowed to invest in, what are the good things? You want, energy ideas. You want these alternative energy platforms. You want, technology. You want water. So all of these things suddenly, even though they have this sort of label that's been tainted in the past, they're actually really great investments. And that's just something that, I would say the bad behavior of some of these asset managers or banks or rating providers of the past, you've got to put that in context and say it doesn't mean that you should ignore stuff which is ultimately going to be of value to your, if you're an investor for the future. And then we've got to think about the other box. And the other box where banks are not allowed to fund, they've got to reduce the CO2 in their portfolio of loans. Now, that's a bit of a shame because at the end of the day, they are being regulated. They don't really have a choice about what they can do. Probably the speed they have a choice in the reduction. But, understand that a lot of people believe that this net zero target date is unlikely to be met. And if that's the case, then think about, the damage caused by not investing in oil and CO2 related industries. And that's just something that investors, I think have thought about. And you're seeing a number of people saying, well, look, we can't just be pure ESG because we think and we believe that that some of these industries don't have as much risk as the ESG rating is telling us. Yeah. So if the ESG is saying, you won't be able to use your oil in 10 years time, well, we think A, that we can, and B, that these oil companies are very, very good maximizing, what they get out of a barrel of oil. So, those are the two aspects of ESG.
So actually, if I look at it as a layman, I've put the second slide on already, which is the predictions for funds which are going to be invested in the future, especially into the ESG markets. And the growth rates are, at least the forecast for the growth rates, are still tremendous. If I bring that all together and say, okay, the greenwashing thing is over. Now we're talking about real ESG investments, where responsible investors make responsible decisions. And then my old adage, I want to do what everybody else is doing. I just want to do it before they do it. It could be a viable market to say, yes, this is a trend which will sustain itself, at least for a couple of years, till eventually it works out and they outperform classic assets, or they all go broke. Because on that notion is one of the presidential candidates in the United States, Vivek Ramaswamy, I hope I haven't butchered his name. He set up Strive Asset Management, and he's totally against ESG and said, I, first of all, have the fiduciary duty to make my investors more money. If I can do that with ESG, it's fine, but that's not the frame I'm looking at. I'm just looking at, can I make money out of this? So if I interpret you correctly, the bad times of ESG, the cowboy days, let's call them that, are over. And now we're talking about real sustainable investments, and the forecasts say more money will go into these sectors, and it's supported by the state. For example, I've read an article a while ago that the ECB actually wants to provide special facilities for ESG high score investments out there. That all comes together then into a territory, even I don't feel comfortable with it. It could be a sustainable trend. Am I getting that right?
So, yeah, broadly, yeah. But even for the people who say, look, we don't have an ESG focus, that's right. I get that. They don't just they don't scan only for ESG. But I guarantee you, when you look at their portfolios, it's full of Apple, Microsoft, it's going to be tech. And within that tech world are going to be people who are developing, battery related products and all sorts of stuff like that. It's technology that I think will be the big driver of this ESG thing, because you have to transition, the old energy into new energy. And how do you do that? You have to invest in research and develop, and that's just technology at the end of the day. So, basically cutting out ESG is the wrong thing. You should be focused on, if you're focused on sort of, making money, you'll probably find that a lot more companies fall within the band of actually they're the great opportunity of the future. And the point you made about the ECB is so bloody important, because this is the big thing, right? So you're transitioning, you've asked your economy to transition from CO2 to non-CO2 related energy source. Well, how do you do that? How much money do you think you need in order to do that? And I think the answer is trillions. Yep. Well, go and have a look at the balance sheet capacity of banks, and you won't find this sort of trillions available for new funding. So who is going to fund all of this stuff? It's going to be governments who guarantee this huge amount of capex that effectively is going to, it's going to help grow the economies in Europe, in the UK, in the States. This is actually a big win. Ignore whether they will reach their targets and all of this stuff. Totally different question. The point is, now you can imagine that when people go in and say, I need funding for this idea and this idea, suddenly they're going to get the green light. And the banks will say, well, actually, they'll look over their shoulder and say, ECB, does this sort of fit within your parameters? And ECB, yeah, that will fit in. So yeah, we'll lend you the money. And suddenly you've got a wave of capital expenditure that, in Europe, when did we have this boom? Forget the infrastructure. You need to build out your infrastructure. You need to build out your grid. You need to build so many things. Who's going to pay for all of that? And it's not going to be new investments only. This is going to be government-backed, and I say government-backed, this is going to be government-backed ECB. You go and make sure that these guys can actually fund this stuff. And that's actually a very, very positive thing for future growth, because without that, go and look out the window and say to me, oh yeah, that looks like a growing economy. It's not.
Well, we've heard last week that the digital currency is coming, which gives them more ability to actually steer the economy in their directed way they would like to please. That gives me the segue, because I'm not a cryptocurrency guy, but talking about ESG, we had the conversation, is actually the Bitcoin, is that carbon neutral? Not really at the moment, right? You need still a lot of energy to mine it, and a lot of this energy is coming out of CO2, nasty bits of energy, but that's not actually not really the question. I found this interesting slide about the bear markets in Bitcoin out there, and 2022 bear lasts now 490 days. I know you're into cycles, Nic, and you have a lot of sophisticated tools available. What am I going to do with Bitcoin? Is that a bottom which I'm willing to buy, or is the bear market continuing, or is Bitcoin actually dead? Because if you introduce a central bank-backed digital currency, surely you can only do that by making the competition out there illegal.
Well, okay, there's a couple of points in what you've just said, making things illegal. I mean, if you look at what the SEC did 2 weeks ago, thereabouts, regarding Coinbase Binance, you know, this is part and parcel of their attempt to choke off cryptocurrencies. And Gary Gensler, who's head of the SEC, let slip in an interview, well, we don't need cryptos. We've got, electronic dollar and euro and pound and whatnot. So he kind of let slip the truth, and that is that the regulator doesn't want this stuff. However, what he didn't make illegal at the time was Bitcoin. So he actually gave the green light by not including Bitcoin in this sort of what is, he defined securities and needs sort of special, how do we say, you need to sort of note this thing with the regulator, and there's no real process, and it's basically another excuse not to allow it. But the point is, he didn't say there was a problem with Bitcoin. Now, if you think about how big the gold market is, the gold market is around 11 trillion, 12 trillion, something like this. Bitcoin is $500 billion. If you really are worried about this, it's far too small. But obviously, the technology of Bitcoin and crypto is very important. And so Hong Kong, China, who previously banned all of this stuff, they are encouraging people now to go and set up shop in Asia. And, that just tells you just how big this thing is. So you talked about the bear market in Bitcoin and stuff like this. I would simply say, what is Bitcoin? What is gold? In an environment where that the US, UK, Europe will almost certainly just have to continue printing because there's nobody else who's going to buy their debt. The US has a deficit of 32 trillion.
Is it already 32?
32, I think. This week it crossed 32. So, and they've got an annual deficit of 2 trillion a year. So that's going to be, by 2030, there or thereabouts, 50 trillion, right? So that is, sooner or later, these numbers are going to count. And, just by debasing the currency, you need to find stuff that, is going to protect you against these sovereigns that are debasing your currency.
Now, let me stop you there, because that is the perfect line. I've already put the next slide on the screen. It's the gold cycles. Yeah? If I understand you right, Bitcoin has slipped the focus of the US regulators at the moment because it's actually too insignificant to make a difference. But then if they continue printing because they have to save the system, then I've put a slide now on the screen which predicts the third gold cycle we have here. So, and that's the point, yeah? We always think, oh no, nobody can prohibit gold. Well, Roosevelt did it. He simply said, everybody, okay, fine, no private citizen is allowed to hold gold anymore. Hand it over to me. I give you, I don't know, $30. And after he collected all the gold coins, that were in circulation at the time. He said the new price is now 38 or 42. I'm making the figures up, but it's pretty much what happened. So if gold is your real protection you have in here, is there a third gold cycle which could lead to significantly higher levels? Because at the moment, the market seems to lose its enthusiasm a little bit for gold. There was this talk over the last weeks, oh yeah, we have new all-time highs, we have a breakout, could be trading at $3,600 soon. I'm not seeing that at the moment. This chart about the long-term cycles in gold actually predicts exactly that. Is it rubbish or does it make sense?
So, you know that I like charts, and I do follow gold, of course. Why not? It's not just the macro view regarding, what choice have you got as a citizen anymore, regarding what you do with your money. Of course, you can go and buy your 2-year gilts and your 2-year US Treasury, but we'll soon see how long these central banks are able to maintain yields at that level if you really do choke off your economic growth.
Yep.
Because then your tax revenue falls and so on and so forth. That's not clever. So from the macro perspective, you need gold, you need e-gold, Bitcoin, crypto, and some real assets and, possibly certain commodities, other commodities going forward. So, gold is part of that story. It's the thing that's hopefully going to protect you against the debasement that is coming. We think it's coming. It's certainly been coming. If you look at the value of gold, versus the dollar, as you've got here, it's only going up, which means that the value of the dollar is going down. And if you look at it versus sterling and euro, it's the same thing. And of course, we have, this thing is not a straight line. And, even I have been saying to my people that I still see that we haven't quite perhaps bottomed in gold, and I'm waiting for a turn in the signals that I use before I'd say, yeah, it looks like the coast is clear. But nevertheless, the story on gold for me is, 2,000 is too cheap and multiples higher. Put it this way.
All right.
Your arrow up to 10,000 is perhaps hopeful, because then we really have a disaster in what's going on in the rest of the world. But somewhere between 3,000 and 5,000 is not unreasonable. And what does that do for the governments of the world? It says, okay, this 11 or 12 trillion economy is asset is going to be 25 trillion. In the greater scheme of things, with 300 odd trillion of debt around the world, that's next to nothing.
Well, first of all, it's not my chart. I found it is Crescat Capital, limited liability company. Never heard of them, but I like the chart, especially the explanations.
I see that.
And no, it's an interesting point. I wouldn't call myself a gold bug, but I think gold has a very important function in preserving wealth over the long term, and that's why I'm with you. I was just surprised because we've seen this enormous talk over the last weeks. Yeah, gold is going to explode. It's not really doing it. Maybe it's not the right time, and we can see more sideways markets. But the picture crystallizing out of our conversation up till now is actually that government policies write our asset allocation at the moment. When I take your thesis at its word and say, fine, governments have to inflate their debt away. Fine, how are they going to do that? Well, they're going to print more money. They have to take interest rates down. Fine, I could invest in bonds. What is the same time my protection against a complete devaluation of my currencies? It's gold, it's Bitcoin in there. And then we come to the point, actually, equities are never good in rising interest rate environment or in reduced earnings in there. They're only really good if the commies take over and you have huge inflation and government pushes money at corporations to fulfill their short-term targets, till it eventually is not that way. And one of the slides I found very interesting last week, obviously we had how did they call it? An aggressive skip or an aggressive pause. What was the right phrase for it?
Yeah, I think that's right. It was going to be a skip, wasn't it? So they decided to skip, and the skip implied that they were going to forget about this one, but they'll do the next one. And I think that's what Powell said. And then he was asked, well, why bother skipping at all? and then he mumbled something. But at the end of the day, I think, the reason for this was possibly because remember when I spoke about the TGA account, which was this account of the Treasury, which was only being run down, added liquidity to the system. And that now that the debt ceiling has been lifted, this TGA account will actually needs to be refilled. Well, when you refill, you take liquidity out the market. And I think he probably didn't want to throw in at the same time as they're refilling the TGA, again, another rate hike to throw, another wobble. So I think he wanted to sort of remain flexible and see how the market reacts to the TGA getting refilled. And just on that, I mean, there is a liquidity drain, in the time since. Let's see what happens in the next few days. But where the theoretical S&P is versus the level of liquidity that we've currently got, it's about 200 points above that level.
Now, I came across this slide about the breakdown of the CPI numbers by Steno Larsen and Bloomberg and Macrobond. And I thought, I'm a big fan of bell curves, and just on the energy sector, this drop in CPI is clearly out of something which in my playbook signals a bloody recession around the corner.
I know.
And
I know exactly what you're saying.
That is, we had this conversation before we started.
We have indeed.
I said, Nic, I'm absolutely spot on. My forecasts are 100% accurate. I only have one thing that doesn't work quite out. The market is not doing what I bloody predicted they would do. At least on the economic indicators, I'm right. And a couple of more interesting slides. Obviously, AI. I found this very interesting. How is the improvement in productivity and profits through AI in the industries out there? High tech obviously is huge. Retail, banking. There are all these perspectives. Nobody can now judge what they're doing. I just have to say, I write the occasional articles in magazines, and I've used ChatGPT actually to do the proofreading now. They have usually their editors. I write something, I send it to the editor. He has a look at it, checks for all the misspellings in there, uses a different word, twists a little bit, and something better comes out. I've done it now on ChatGPT, and excuse my language, it's fucking awesome.
See,
it's unbelievable.
What a great thing.
Yeah, and it's still my text. It's not completely deconstructed or anything, and it gives you a little comment at the end I haven't even asked for, down the lines of, well done, Thorsten, good writing. So I appreciate that. I can see where everybody is coming from. And down this line, obviously, we are both old enough to have been right in front of the screens in 2000. And that is an interesting slide which shows you the news flow about internet in 2000 and the news flow in Bloomberg about AI, compared 2000 against 2023. And for those of you who are just listening, we are now at the level with AI reporting where we have been at the peak of the dot-com bubble in 2000. Yeah. So again, something which for me makes me very, very cautious to be invested right now. And here's a beautiful deconstruction about the contribution of the Magnificent Seven, or how many there are now, in year-to-date return contributions to the S&P 500. And while we discussed it last week, without the Magnificent Seven, the S&P is actually flatlining this year. Yeah? I haven't seen anything. So we have clearly a bubble in this market. The unfortunate thing about a bubble is nobody knows how long the bubble will inflate before it eventually pops.
You know, the bubble, if I just may add, is the sovereign debt. This is the biggest bubble, is the sovereign debt bubble, and because of the sovereign debt bubble, there has to be a bubble everywhere else.
Yeah,
and that's just kind of fundamentally. You know, you're going to show me a chart now of the economy falling.
The global economic surprise index from Citigroup. What does it say? It's a beautiful chart which says if we are below the zero line, That simply means the forecasts are more bullish than reality actually comes in later, which means everybody is forecasting, yeah, everything will be all right. And the real numbers then coming out tell you, no, it's not the case. And we are here now in serious bad territory.
Okay, I mean, a lot of these indicators, just be careful, they are, backward looking.
Of course.
But the bottom line is the economy in great shape? No, it's not. It's clearly not in great shape. That's why they've had to chuck a lot of liquidity into the system to kind of kickstart this economy. And what's the worst economy around the world is China. So China's facing a deflation, right? There's no other word for it.
That's actually surprising. They reduced interest rates by 25 basis points last week, right?
That's huge for them. Yeah. They normally do 5s and 10s. So they are in a deflation, and they have to, as I said, there is no government around the world that can accept an economy that's not stabilized. And if you have a destabilized market, it's like the gilt market. The gilt is your currency. If you're, the UK, you cannot have this disorderly market. You cannot have a disorderly treasury market. And it's the same thing. You have to continue to keep this thing going until you get your debt in order. And there is no solution where you are austere and to get your debt in order. All that does is just simply create a bigger problem because you need tax revenue. That is the fundamental thing. So what is the right level of interest rates? The right level is much lower. We've got demographics which are, pointing in that direction, and inflation will come down. But inflation may prove sticky. Inflation may prove that, you may not get to 2, you may get to 3 and a bit. And then in the meantime, you are still turning this interest rate dial if you're a central banker, and you're wondering, well, what's going on? I don't really understand it. And what's going on is the money that you're spending to transition the energy, the money you're having to pump in the system to actually turn your economy around. You had a chart with Mexico, right? The amount of investment that is going on nearshoring into Mexico, it's huge. So this is all itself kind of an inflationary thing because you want to move your production somewhere else. So your interest rates your inflation number is going to be a little bit higher in the short term whilst all of this is going on. Yeah. And this dial that you've got of interest rates is the wrong dial. It's a blunt instrument and is wrong. And they need to think about that because if they really do cock things up and they send the economy into a tailspin, how stupid they would look if they sort of say, well, we've decided to cut interest rates and pump a lot of money into the system. It just goes to show how little they understand. At that stage, Bitcoin will be substantially higher, gold will be substantially higher, because people will just say, these guys haven't got a clue what they're doing.
One of the things that I'm still missing, actually, to confirm my thesis that we are about to implode, is I have a slide now, a number of IPOs in the United States. And if you compare the 2000s, the real bubbles, we had, well, a slew of IPO. I remember the times we had a bunch of investment bankers running around and their assistants had even assistants. We spent huge amounts on our investment bankers, bringing every growth stock to the market that was just pretending to have revenues. Let's be brutal about it. What we've seen now is nothing like that. By my counts, I would have actually predicted, maybe it can pick up now, that we have a lot of IPOs coming out, especially on the artificial intelligence side of the business. And the market data is not confirming that at all at the moment.
Yeah, I don't know how to, read this other than from the chart you showed earlier, which showed that the dispersion of companies, generating returns versus not generating returns earlier on, effectively, you used up your ammunition on companies with huge growth prospects in 2021. And you see that with all these SPACs that were issued and so on and so forth. Yeah. And they led to disappointment. And many of them, if not all of them, are still way underwater. And you can't come in 2022 or 23 and say, now I've got more where that came from. So, you need to kind of prove your stories of the past But I haven't really thought about, the IPO market and the state of the market. Is it ready for IPOs? Probably
well, one interpretation could be the opposite, to say, fine, if the IPO market is actually dead in the water, that could also be an indicator for the economy again. And here I have the ISM New Order Index on the screen. We are now below the 50 line. Maybe a side note, this week I heard in Germany that the new building permits have dropped by 25% in Germany. So what we're having now, we are officially in an inflation now, Germany, Europe. We are in a recession. Inflation is still a big topic. The DAX is making new all-time highs. And when I talk to people out there in the industry, in the engineering sector, a lot of the tradesmen out there are already inquiring for new jobs for the fourth quarter this year. This hasn't happened in years, Nic. At the moment, they're going through their order books. Yeah, they can still pay the bills and everything is all right for the time being. But they're already inquiring what is going to happen within the next 6 months or after the next 6 months. And I thought that is actually one of the points, if I have to stick to my guns here, what's the upside, the potential upside I see in markets, and what's the potential downside, the asymmetry of will the DAX or will the S&P double and has the chance of losing 25%, or is it the other way around? Can we, I don't know, gain another 5 or 10% to the upside? But the risk to the downside is massively increased. If I look at the economic data, here's again from the conference board on the screen, it also looks horrible. It's actually confirming the charts, which I'm always trying to entice you to agree with me, even though the market doesn't agree with me. All the data out there gives us a forecast. Stay away from markets, especially equity markets. Don't put your money in. The coincidental factors or even the leading indicators, your private surveys in the building and construction industry, which is a bigger part of an economy, gives me all these indications that I don't want to really be long here. That's why I put on the straddle 2 or 3 weeks ago, or it actually kicked in exactly at the level I forecasted to, well, make the upside if we see it and benefit potentially from the downside and an increase in volatility. I'm just scrolling slowly through these charts. They're all from the conference board. They all show the leading indicators. All leading indicators are pointing direction south massively. And I just can't get my head around to believe what I see on the screen, that this is sustainable, we can see at the moment.
Yes. Now, just, bear in mind all of this stuff. And there are loads of macro guys out there who also look at the same economic numbers and say, well, therefore, leading indicators are down, therefore we sell. It's not the link between these economic indicators and a stock market. You just cannot trade these things. I mean, if you did, you'd be toast already. You'd be short since, last summer. And you might have been right, actually, for 1 or 2 months, I think, till October. Yeah. And since then, you can almost, I think, is this the chart or another chart? If you have a look at all of these indicators and you say, well, hang on a minute, surely at the same level of where we have been, the market would have fallen from here. And at all of these points, what did the central banks do? They chucked liquidity in. They threw liquidity into the market, and suddenly those those obvious bits of data that you look at and you say, well, hang on a minute, on this level now we should sell because at the previous time it was at this level, the market collapsed, therefore we have to sell it. What happened? The central banks, the central banks were in, and they chucked a lot of liquidity. They did it once, they did it twice, and they did it at the time of SVB. They did it at the time of the Gilt crisis. The central banks do not want to see these markets lower, and in spite of what you're looking at with interest rates and with leading economic indicators, they can't afford for the markets to go lower. Already, tax revenue is, for where we are with such high levels of employment, low levels of unemployment, tax revenues should be much higher. They are really low because, other parts of the economy are also not working. They cannot keep interest rates this high for much longer. They really do need a turnaround, because if the economy does break, they will be in a death spiral, and then suddenly you are in a worse situation than you can possibly imagine, because the government debt bubble will start to implode, and that's not good.
And let me argue like a trader now. We all know that, yeah? I'm totally agreeing with you. The Fed will reduce rates, but they will not reduce rates as long as markets are stable. Even if I want to go long, wouldn't I rather wait before something breaks and then the Fed has the reason actually to lower rates and lower rates and lower rates anymore? Because if we are now in a stable, well, officially we are in bull market territory again in the United States, there is no reason for the Fed actually to lower interest rates. There's no indication that they're going to do it, but the market is playing as if it has already happened at highly elevated levels. I would rather wait till there is a break and then wait a little bit longer till there's a panic in the market and I can see that they're actually doing what you predict. And then I would like to invest, not at this point in time.
So, let's just get this right. My thesis is not that they will cut rates, therefore the market will just sort of go to the moon. Because as you rightly say, if they cut rates, there's going to be a reason for it. And if there's a reason, you don't want to be invested at the time that they cut rates. So they cut rates is the disaster time. That's why I said, for me, in spite of what the Fed are doing, if on the one hand they're raising rates, but on the other hand they are continuing to supply liquidity, which we know they are. As I say, there's a little bit of a gap right now, so we may see a little bit of a retracement. But all of that aside, if they are keeping the market up, we will, expect to see a new high, and then I'll reassess. But since the low, very close to the low, my signal's been pointing upwards, my chart's been pointing upwards. And the underlying thesis that there will be liquidity continuing to support the economy. And now we have to see whether all of this money that they've thrown in actually starts to impact some of these economic data points. And, the UK, I think, is a little bit different, and they're not doing anything clever. But I think the US and the Chinese are doing their best to invigorate their economies through this extra liquidity. The Chinese, obviously, they can afford to cut rates because they never pumped, they never gave the monetary fiscal stimulus that the Western economies did. So, they are all trying to grow their economies right now. And you may start to see that being reflected in the economic data, because liquidity is a forward indicator. Liquidity in the system, it's going to go somewhere. It's going to spill out of financial assets and into the economy. And that's the idea of it. And you start to see these things. And I think the theory goes, 6 to 9 months is the kind of lead time to expect to start to see things in the economy. And we have to see.
No, I agree with you. I'm actually quite happy with my position at the moment. The straddle I announced 2 weeks ago already made a little bit of money. It's fine. Volatility is at extremely low levels, but when I opened it, it was already at extremely low levels. The delta is working in our direction at the moment. We're on the upside. I don't know why, but hey, fine. Let it rip. I'll make money out of it. And then when I've made my house money approach, the call has generated profits to finance the whole position, I'll just keep the put open. It's not a short-term trade. But now let's go to the fun bit, Nic. I stumbled across this article. It was about financial influencers. And this first chart, it took me a while to actually realize that was ironic. Top Finfluencers generate significant alpha. So they had a simulation. You see a beautiful bell curve here. And then they had the data, and it showed that the top financial influencers were actually doing fuck all. Yeah, it's entertainment value. It's fantastic you have out there, but the alpha generation is exactly as simulated, a mean of 0. You have a couple of good guys, you have a couple of bad guys, and then
doesn't surprise me.
A big chunk in the middle. Well, what's positive for us is actually the next slide, which tells us there are skilled, anti-skilled, and unskilled contributors in the market. And surprisingly enough, there are a lot of anti-skilled influencers out there. So actually, you should do the opposite, what they're telling you. Then there are a couple of skilled guys out there, but their returns are reasonable, but not completely unwhacked. And then you have the simply unskilled guys out there who don't know what they're talking about. So they arrive at, well, something they pull out of their behinds, coming up with it. And what it all shows us, the anti-skilled finfluencers have the largest following in there because they're entertaining. They make a big show out of what they're doing. And I thought that gives hope for us, because in this scenario, we've now cracked the 300 subscribers. I wouldn't call us anti-skilled or unskilled. We're probably two of the guys who know what they're talking about, even if markets at the moment give you more credibility to your opinion than to mine, even though my positions still make money, so I can't help it. But on the Finfluencer side, would it be a thing, Nic, if we start something on Twitter as well?
Frightening. That's you know, I grew up in the East End of London, and I wouldn't even go on Twitter.
All right, fine. I just wanted to slip it in, and I want to finish today again with the market sentiment indicators. Here you see US value versus growth price momentum we have at the moment. The question is again, is it this time different? The market is overbought at the moment. Yeah, we should see a temporary correction here without any doubt. That should happen at any minute now, especially call option buying last week was at the highest level since, what do we have here, since 2005.
Now, so, you are the expert here, but when I saw something like that, you know, this week, I felt that was a capitulation, because the classic trade to sell call options, you know, into, you know, over this 4,300 level, 4,200 level. I mean, it was the easiest thing just to cash in and make money. Nah, it's not going to go there. It's not going to go there. Look at the leading indicators. Nah, it's not going to go. And suddenly everyone gets caught out. And this capitulation is usually, you know, I mean, that's like a big thing. And, you know, what was your read on that? Is that a
exactly the same? What you see before you see the correction is that the bears out there, and I'm putting myself into the bear camp, actually had enough of it. They don't want to short the market anymore. They're never going to buy the market. They leave that to other people, but they're sitting on the sidelines now watching. And here is classic FOMO in the game. Okay, apparently markets are going to rip to the upside. I want to have a chunk of the action. So I'm going out there and start buying calls. What I always observed in the past, before the market went to a big dive, volatility was abundantly available. We've seen that before the 2020 Corona crash, when out of our analysis, the market was already overvalued before even Corona came in, and volatility dropped down to the level of 13, sometimes even slipped below 13. It's this phenomenon that the insurance policies are the cheapest just before your house catches fire. Yeah. And in my interpretation with the last bit is, obviously, I like the CNN Fear and Greed Index. We've been high last week already at 77. Today we are at 82. We had triple or quadruple witches on Friday. So on Monday, I assume a lot of material could come into the market. No, Monday is closed, right? We have Juneteenth or something. Yeah. Out there. So we have extreme greed, all technical indicators, even though I'm not the biggest fan of them, but look at the RSI. We are in absolutely overbought territory. The fundamentals are not looking good at the moment. And especially the chart with the call buying activity I saw on the market is exactly as you described it. It's people are surrendering to the idea, well, yeah, well, let's take a part of the action. Markets apparently are going up, and if I'm not long, I'm an idiot. And closing it on that altogether, my short-term prediction for the market is we will definitely see a correction. Yeah, famous last words, definitely. But I see a weaker week ahead of us next week, because this looks just too much like FOMO at the moment for me, while the fundamental data are actually not confirming what we can see here. So on the short term, Yes, I think we see a correction. Medium to long term, what we discussed the whole podcast, I can't really make up my judgment at the moment. So I'm positioned that I can have fun on both sides of the equation. I think we'll see a market to the upside. Then I will sell out the calls, which I hopefully will have made money on, and leave the puts on for on house money. And that's not a short-term trade that is stretched into September, October. So these are my famous final last words. What's going to happen? We'll see what's going to happen next week. Anything to close that out from your side, Nic?
No, I mean, I think that's not unreasonable. On, you know, even on my chart, you know, I'm looking for a small pullback. So, you know, given that we talked about, you know, the liquidity gap between, you know, as the TGA gets refilled and from where, and is this a drain? Is this not a drain? You know, we need to see how this thing over the next few days evens out. But if there is a net drain, then it could well be that that might be a good clue for people who are now all monitoring liquidity. Everyone's a liquidity expert, you know, frankly. So they're all monitoring the same numbers as I do. And that may well just sort of help this pullback a little bit. But it's just a pullback because I don't think the move has ended, and we still over, you know, the next months we'll still see a new high.
Thank you very much, Nic. I'm looking forward to next week to see whether what we discussed today has any impact. And especially thank you very much for enlightening me on the United Kingdom and ESG. I'm going to support ESG companies further and send my regards to the family. Thank you very much for being my guest today. Bye-bye.
See you. Bye-bye.